It's nice to see you all. I was joking with Kelvin, every time I come here, the market implodes a bit, and so I'm afraid that I might be bad luck. But I want to share a bunch of different ideas with you all today, sort of a follow-up on what we've done in prior years. I do want to start with just a quick reminder of here's what we're going to try to do. I'll talk a little bit about what happened in 2024. I'll talk a little bit about our outlook for 25, and then just some top questions that I've been getting from clients. And I'm happy to take questions at the end if we have some time. As Glade mentioned, my job is to work with the largest clients that JP Morgan partners with. And I spend my days, nights, and weekends talking with these clients, helping them manage their investments, and helping to plan for the long term. And so it's sort of with that lens that I come to you all to talk a little bit about what we've seen and what we think is going to happen. Let's just talk quickly about 2024. And by the way, I went way overboard. I made too many slides. If anyone wants these, you can email the team or myself, and we'll get them to you. I'm going to move quickly, but I do want to hit on a few things that I think are important. 2024, was a really good year for risk assets or equities in particular. They were up over 20% last year. The chart on the right, which is going to be too small for you all to read, basically shows all through history how often we had these 20% plus kind of markets. And last year was actually the second year in a row that markets were up 20%. Historically, like 80% of the time that happens, you get positive returns the next 2 years. Now we're going to talk a little bit about the administration seems to be trying to challenge that view. We'll get to that in a little bit when we get to the outlook. But history does tell us that when you have these really strong markets, that momentum tends to continue. And that's often because it's happening at a time where there's some sort of shift in the economy. Think of .com, the advent of the internet, and I would argue what's happening now with AI and innovation is probably what may drive upside from here if we can get some of the potential policy missteps out of the way. I'll jump a little bit ahead. So when I came here a couple years ago, people were pretty bearish back in 2023. And we articulated why we actually thought the market looked pretty good. And this is, in my opinion, one of the most important charts. On the left-hand side, it's telling you corporations, even though interest rates were higher, corporations were really smart and termed out their debt. And so while rates were going higher, their interest payments actually went down. It was the same story for individuals. Rates were moving higher, but because most individuals in the US, their largest asset is their home, because people have 15 and 30-year mortgages here in the US, they never actually felt the pinch of higher rates. And so when rates started to go up in 2022 and they moved so quickly and financial markets sold off, you never actually saw that impact flow through to corporations or households. And that's why when the Fed was able to start cutting last year and normalize, we never saw big cracks in the economy. That's how they mastered the soft landing in the US. At the same time, it was happening globally, where you had rates coming down in developed markets globally, as well as inflation coming down. And it looks like one of the charts didn't quite flow through. But the point is, we had a soft landing in the US, rates and inflation coming down globally. That led to a backdrop globally that was actually pretty strong. And that's how we ended up where we were with really strong market performance. And this is just showing you across different geographies and asset classes. The best performing asset class was actually gold last year, up about 28%, but right behind that, US markets up 25%. But what's really important is you even saw other developed markets, Japan, China, et cetera, also up. Even Europe was up 1% last year. And so broadly speaking, it was actually, I would say, kind of a miracle. If anyone had asked me 2 years ago, is the Fed going to be able to unravel this rate policy view without causing any major issues, I would have said it's unlikely. They pulled it off. And that's really the big story, in my opinion, of 2024. So I always want to talk about, keep me honest, what did I say here last year? Did it work? Did it not? There were 5 big things we talked about. By the way, I don't grade myself. My team does this, so it's unbiased, although I do pay them, so I guess there's a little bias built in there. But broadly speaking, we were here last year talking about we thought the rally would continue. It did, so we get a thumbs up there. We thought rates were going lower. They did. The Fed was able to cut, so another thumbs up. We talked about using bonds in portfolios as a way to try to insulate against risk. Bonds were up last year, but of course they lagged equities pretty meaningfully, so I'll give us a mixed grade there because if you had $1 to put to work, you were much better off buying equities than bonds. I said we believe early stages of AI, we think it's going to keep driving margin expansion and that it wasn't too late to own stocks like NVIDIA and Amazon, et cetera. That worked out. In the last one, we talked a lot about elections because we had a lot of global elections and of course the US election. I argued not to fear that and to stay invested. That worked out in 2024, Although, and we'll get to this shortly about 2025, if you've stayed invested as you were post-inauguration, the last few weeks have obviously been pretty brutal. And we're going to talk about that a bit, so I'll give us a mixed grade there because generally I don't like to pull out of markets around elections, but maybe we should have seen that this administration was pretty serious about some of the stuff they were saying and taken down some risk into them actually going into office. So, fast forward, now we're in 2025. The big challenge that markets are facing right now and why we're seeing so much volatility, I think these two charts tell it very, very clearly, at least to me, and I'll explain why I think they should be clear to you. The left-hand side, these are S&P valuations, so how we value stocks. They're near all-time highs. Now, there's reasons for that. We actually think the economy is pretty strong. Tech companies are more profitable than they've been in the past, so valuations should be higher, but that just means there's little room for error. It's the same story in bonds. That's the chart on the right-hand side. Credit spreads are very tight. The credit market's telling you corporations are healthy, there's low risk of defaults. These are all good things for the underlying economy and for markets. But what this means is when you interject any sort of noise, uncertainty, or just strange headlines into the market, it can cause pretty significant volatility, and that's what we've seen the last few weeks. I'm going to skip over this because the chart are a little mangled. It's also important that besides the fact that valuations were priced pretty well in stocks and bonds, people were really, really bullish going into 2025. Again, we got through the election without a whole lot of noise and friction. The market rallied into year-end, and almost everybody was very bullish into 2025, and that's a Barron's headline arguing why they thought stocks could gain another 20% this year. Now, by the way, that was never our view. We came into the year looking for 7 to 8% kind of returns. It's higher now because we haven't adjusted our view after this pullback. But this setup, everyone bullish, valuations kind of priced at the high end for stocks and bonds, creates a backdrop that can be fairly volatile for markets. And I think that's why we're seeing some of the noise we're seeing today. Little chance you all can read this slide. I'll read it for you. These are all of our expectations across asset classes. The most important thing here, we think the S&P ends the year between 63 and 6,400. That's about 13% higher than where we are right now. So we are still saying that we think this is a good time to think about entering markets. The challenge, though, of course, is I think we're going to see more volatility over the coming weeks and months. And so I don't think what we've experienced the last few weeks is done. The other most important thing to take away from here, we think inflation continues to come down based on what we know right now and what the administration is doing. That could change. And we think the Fed is able to cut 2 more times this year. The market is pricing in 3 cuts. We think it's going to be 2. Significant changes to the inflation outlook and the Fed's outlook would obviously change what we think markets will do. But I probably should have led with this. In spite of all the noise we're seeing and all the volatility in markets, we are still cautiously optimistic. That is predicated, though, on the fact that the administration eventually starts to calm down some of the whipsawing around tariff commentary and other things. That obviously remains to be seen. Last point I'll make just quickly about sectors. We actually think there's a lot of opportunity in the US. It's not just about owning the broad market. Industrials, healthcare, financials, utilities, we see really attractive growth in many sectors. And so that is another positive when you think about markets because the growth isn't all coming from tech. That's what people are assuming. It's actually quite widespread. And we actually have 7 sectors out of 12 in the US that we think will produce near double-digit earnings growth this year, which is pretty good. So, what do we do? And where are we getting questions and where should we all be focused when you think about markets? By far, the biggest one that I'm getting, and it's taken up all of my time, is what on earth is going on with all the policy changes and with the tariff noise? It is, JP Morgan employs a lot of economists. I'm more of a market person, I'm not an economist, but I can tell you every single economist that we work with is not supportive of the tariff policy. Not because they don't believe tariffs can be used as a bargaining chip, they can be, and they probably should be used against countries like China who are stealing our intellectual property. But when you try to use them very broadly, and you announce them, take them back, and there's all this noise day in and day out, it just causes too much volatility in the market. I think it's also worth noting that what the administration has proposed, lowering taxes and making up that deficit from tariffs, has not worked or happened in the US in over 100 years. So we're talking about shifting our fiscal policy back to where we were in like the 1920s and 30s. Obviously a very different economy today, a very different world today, and that's why we're kind of skeptical, that's that chart on the left, that they're actually going to be able to pull this off. Because when they talk about tariffs and covering the gap from lower taxes, they're assuming that people still spend the same amount. that I'm not going to mind that things are more expensive, that my car's more expensive, and consumers are still spending. And our best economists think that's a very questionable assumption to make. And so we could actually be in a scenario where tariffs are implemented, people start to cut back spending, and then you cut taxes and you have less revenue coming in and less revenue from tariffs, and you actually make the deficit worse. That would obviously be the worst case scenario. Again, I'd hope that they'd tone down some of the tariffs and are able to do them a little more targeted, increase revenue there, and maybe moderate some of the tax cuts. TBD, though, on that. The other big thing about tariffs, this chart on the left, this is views from economists who are saying, okay, if we actually do all these tariffs, will it be successful in bringing manufacturing jobs back to the US? 85% of economists we talked to said no, that it's not actually going to bring more manufacturing jobs. That's a little bit scary. Seldom do you see people agree that broadly on a topic. The right-hand chart here as well, red states disproportionately impacted by the impact on manufacturing and higher costs of goods from tariffs coming in the US. Now, this administration, presumably this is their last, so maybe they don't care about re-election, but I can tell you people in the House certainly care about the next couple years. And so this is going to be an issue for them if they do keep this policy going, because it will disproportionately hit some of the states that have supported them the most. The last point on the policy issues and the concerns that I see is immigration. The chart on the right shows you what immigration could look like and will look like under these new policies that have been discussed. And I think we can all agree you want a safe border and everything else, but if it's at the cost of having people to do the lower paid jobs that, quite frankly, a lot of Americans don't want to do, that is inflationary. Wages will have to go up to entice people to do some of these jobs that immigrants are no longer doing. So tariffs could be inflationary, wage growth going up is inflationary, and you could be a scenario where you're taking in less revenue from tax cuts. By the way, tax cuts are inflationary, it stimulates people to spend. Those are all things that could put cracks in that outlook that I had, where the Fed can actually cut twice and where we still see growth. These are the scary parts of this policy, and I wish I could give you some clarity. Literally this morning, as I was watching the news, you saw Trump getting into another argument with Europe, threatening 200% tariffs on wine and champagne out of Europe. I take this quite personally as an Italian who likes to drink that, and I'm a little bit upset by that. I hope, again, this is just posturing and we're not going to follow through on that. But this is how these things can snowball. They threaten a 25% tariff on American whiskey. He comes back with 200% on champagne. Again, it's noise that we don't need in the market, and the market went from being up this morning to now down 1%. This last one, which again just highlights the stress or the valuation risk in markets. You're not going to be able to read all this, but this is every single asset class we follow. If it's colored yellow, red, or orange, it means valuations are near the high end of historical levels. So there are very few asset classes today where the pricing or the valuation is low. So what that means, again, if we have tariffs, if we have inflation, if there's questions about growth, there are so many asset classes that could be at risk. That's how you end up in a recession. I'm going to talk later about recession risk. This is kind of why the market is behaving the way it is. People are starting to recalibrate expectations and saying, you know what, we were too optimistic coming into the year. The world did look pretty rosy, but now there's just too many question marks. I don't want to be, well, I guess maybe one last point. What has that meant? This is why year-to-date returns, this is through Monday. It would look a little different today, but it's pretty clear to me. Basically, Europe, IFA, Japan, all up. The US being really the lone market that is down year to date. And so you're already seeing an impact on financial markets from some of the noise from this administration. Now, doesn't mean this doesn't work, and it doesn't work as a negotiating tactic, and our view is still that we're going to end the year positive, so we think they'll be able to pull out of this. But the market is clearly looking ahead and saying, you know what, there's just too much risk in the US. I want to reallocate capital, and that's what I'm seeing a lot of clients doing. They've made a lot of money in the US last few years, and they're saying it might be time to start looking at opportunities in Europe, opportunities in Japan, at countries where I have a better line of sight into what the growth outlook is the next few years. I don't want it to be all doom and gloom, because you guys are looking at the healthcare sector. There's still a lot of stuff under the hood that's working. The broad equity market is down, but you can look here, healthcare, industrials, real estate, utilities. There's a lot of sectors that are up. And I'm going to talk about why, because many of them may actually benefit from some of this that's happening, as well as having really strong underlying fundamentals. So there are some green shoots and positive things to think about. When I think about having exposure to the US, this is really interesting, especially for people in the field you're all in. I think it's no longer that tech is the only game in town. It's no longer that you want to own the broad S&P. Clients and people I work with are starting to look at it and say, okay, I need to be more targeted with my exposure. Let's focus on where there's real secular growth. That's why healthcare is doing well. Let's focus on if the administration is really successful at reinvesting in America and bringing, manufacturing and things back on shore, industrial should benefit, utility benefit, because people need to obviously invest in our aging infrastructure. There's also a couple more, I think, positive things that are coming out of this administration. The FTC chair of Trump was on TV again, making his rounds this morning, talking about the M&A environment and how supportive he's going to be versus the prior administration. We're starting to see capital markets start to open up a little more, but again, all this noise from tariffs and everything else is stymieing that. But I do think the backdrop is really strong. The chart on the right shows the inflection point we're finally starting to see in capital markets liquidity and activity starting to pick up again. If we can quiet down on some of the tariff noise and just get some of that settled, we think 2025 and 26 could be really good years for capital markets. That's great for anyone in the private sector who's been trying to get liquidity and get to market, if you have private equity investments, if you're looking for more M&A. We think this administration will be much more supportive of logical M&A, and I think that's a really good thing and a really strong backdrop for US growth if we can get through some of this noise. I would also highlight, again, there are many sectors that could benefit from what the administration is doing outside of tariffs, again, trying to bring more manufacturing and investment back on shore. And we think infrastructure, utilities, like I mentioned before, are two very obvious spaces. And so if you don't have exposure there, haven't thought about that, I think it's an interesting time to look at those sectors that quite frankly have lagged the last 20 years due to lack of investment in the US. I'll skip through some of these because, this one's probably important. Last year I talked a lot about AI, and we talked about how we think there'll be a broadening outside of just like names like NVIDIA into other stocks. We're continuing to see that happen. So I work at JP Morgan, a big bank. We are hiring, sorry if any of my analysts are in the room, we are hiring fewer analysts out of college because we can make them more efficient, because we can do more with less. So what does that mean for us? I guess it's good for margins. We're already seeing a margin impact. And so what I think is interesting about this AI trade is, the first few years of any trend, people tend to go to the obvious players. So you make the chips, you're a hyperscaler, those are the obvious first iterative plays. Now we're starting to see the market broaden out to say, who are the beneficiaries? What are the sectors that will benefit from these efficiency gains? Who can bring, for example, in the healthcare space, drugs to market faster, cheaper? For companies like ours, suddenly you thought margins were maybe at the top of the range they could be at. Suddenly they can be much higher because we're more efficient. The last sector I would talk about, because geopolitical risks are still front of mind, I think, for all of us as well as for many globally, whether it's protecting data from adversaries or just all the information that we've collected as part of this AI exercise, there's more need than ever to protect information. And so one of my favorite ways to think about playing AI in broadening out from the chip makers of the world is to look at security companies, because we certainly are going to have to spend much more money securing our data, our infrastructure, everything else over the next 5 to 10 years. This is a very long trend and one that I think is very investable. I'm going to skip over this because I want to jump more into some of the questions. Other big question I get all the time. Okay, where are interest rates going? I talked a little bit at the beginning. We still think 2 cuts this year. The market is pricing in 3 cuts. The big question that the Fed is going to have is they're looking obviously at inflation data, they're looking at the job data. So far both, and we had some inflation data this morning that came in better than expected, both are supportive of them continuing on that cut bias. But I do think the risk, again, is to everything I said before about tariffs, because the immigration policy and the tariff policy are both inflationary. And if those offset some of the good trends we've been seeing on the job side, that's how things become a little hairy and suddenly the Fed is not able to cut. I want to skip ahead a little bit of this because the big risk right now in markets is, what if the market's wrong? And what if it's not 3 cuts and it's no cuts? Or what if it's 1 cut? Or what if it's a hike? And that would probably be bad, I would argue, for equities, because it means we're in an inflationary environment. Some sectors would benefit, some would not. But it would also generally be bad for fixed income. And anyone who remembers 2022 remembers that stocks were down and bonds were down in the same year. What this chart is actually showing is my argument that even if we're wrong, I think there's an opportunity in bonds over the next 1 to 2 years because you're starting at a higher point and yields are higher, you can actually be much better insulated if we're wrong and rates go up a little bit or down a little bit. And that's really important because when I talked earlier about things being priced to perfection, equities, I think, have much more risk to them right now than fixed income. And so when I talk with people who say, I have a lot of cash, what should I think about? What should I be doing? I actually think fixed income here makes a lot of sense. And what this chart is showing you is if in the middle, if rates don't move at all, versus if rates go down, versus if rates go up, in every scenario, we see actually bonds working in a portfolio, which is pretty interesting. There's not many asset classes right now that I can say would be that well insulated in a variety of rate scenarios. The other one that performs really well is real estate. I often get questions about, can you invest in real estate? We actually think we are through the worst, even in pockets of office in some big cities like New York, maybe not San Francisco, but some of the major cities in the US are finally look like they're turning around. Real estate historically has been a great hedge against inflation. And again, if you're worried and you're saying, no, Monica, you're wrong, the market's wrong, there's no way they're gonna be able to cut 3 times, this is the kind of asset class you wanna look at. The other one that generally holds up very well is infrastructure or industrials, which I talked about earlier. Other big question I keep getting, and probably top of mind for all of you, is a recession inevitable? Sorry, I know these are hard to read for you guys in the audience. We started the year with a 15% probability that we have a recession this year. By the way, that's standard. Any given year, 10 to 15% is sort of the normal odds. I caught up with our team yesterday. They now think that's 30%. So recession risks have doubled. That kind of makes sense based on what you're seeing in equity markets. But again, I do think it's important to remind everyone that there's what the market thinks and it's forward-looking, and that's why you've seen the market pull back, and then there's the data. And these two charts are all about the data. The chart on the left is showing debt as a share of net worth for consumers down significantly. The chart on the right is showing the wealth of consumers based on their market portfolio up significantly. So it's hard to have a recession if people have jobs, if they're not over leveraged, and if corporations are healthy. And I would also highlight the labor market, like I just mentioned, people still have jobs. The labor market still looks pretty strong. And so we look at all this fundamental data and we're saying, based on the fundamentals, there's no reason to think we should have a recession. That's how we started the year, 10 to 15% odds, normal odds. Why we're at 30 now is because we're not seeing it in the data. And we're JP Morgan. We see all your credit card information, all your spending. It all still looks pretty good. Why we think odds are going up is because of the question marks. Again, the policy changes, what could that mean if they are implemented and this chaos continues? What would it mean if we have a government shutdown? Like, those are the risks that are making us nervous, but we're not seeing any cracks in the labor market. The one thing in labor I would point to, we follow quit rates. So how often are people quitting? In a really strong market, you see quit rates go up because people feel comfortable they can get a new job. We have actually seen quit rates start to go down. That tends to be a leading indicator that people are starting to get a little nervous that maybe they don't have as much leverage as they did before. But again, not to the level where we'd be panicked. And again, we're not seeing layoffs pick up in any significant way. And the last point here, again, so consumers are healthy, they have jobs, their balance sheets are strong. Corporations are really healthy. Profit margins are wide, and they don't have a lot of debt. So again, fundamentally, everything looks very, very good. It's just that overhang from all these question marks that is rattling people. And so, I was talking with Kelvin in the back. I'm saying, like, when do you start to lean in and add to this market? If you have a longer term time horizon, I'd be doing it right now. It's a little different if you need liquidity over the next couple of years. But I think in the next couple of months, we're going to have some more opportunities as this volatility continues. Sum it all up, I just don't see fundamentally why we would have a recession. I do want to show one more slide here. On the left-hand side, these are all the sectors that are going to have positive earnings growth this year based on what we know now. We just ended an earnings cycle. Again, we have 7, 8, 9 sectors that we think are going to have positive earnings growth. It's just very hard to have a technical recession when most parts of the economy are still growing. So this is why I can still stand here and say I'm cautiously optimistic in spite of all the noise, in spite of the volatility in the market. But again, bear in mind, the market's going to look ahead and try to anticipate what's happening. It's obviously starting to ignore this data, and it's guessing that in 1, 2, 3 quarters, you start to see a flow through from people being nervous and pulling back spending. We're not seeing that yet by any of the leading indicators we see, but it possibly could be coming. Oh, sorry. This is, I think, the most important one. This explains why the market is down, even though none of the data is showing that we think we're going to be in a recession. This is sentiment. So, like, how do people feel? How do investors feel in the market? Higher means they feel good, lower means they don't feel great. So you can see we've kind of fallen off a cliff where we are right now. We're not as low as where we were back in 2008 or even during COVID, but this is a really important chart because with that drawdown in sentiment and the market selling off, that actually tells me that we could be getting to a better place because people are no longer as euphoric as they were at the beginning of the year. That Barron's headline, another 20% return in equities this year, people no longer think that. So that's a good thing. If we can get to a point where, again, the administration can be a little more tactical and forward and like long-term thinking about some of the changes they're proposing, you're now at a point where we would say sentiment is starting to get washed out, and that makes me a little more comfortable that you could actually start to add money to the market here. Oh, I don't know what happened to this chart. I feel bad that this is like a giant, I don't know why there's a blue box there. Let me tell you what's behind the blue box. It's almost like I'm trying to hide it from you. This is a list of all sorts of scary things that have happened over the last 50 years and what the market did. And Kelvin reminded me that I was here right after Silicon Valley Bank went under. And the point of this chart is just to remind you that there's scary things happening literally all the time in the world, in markets. And in most cases, it shouldn't deter you from investing. And so I'll give you two that were top of mind for my clients. Silicon Valley crisis. When that happened, I was in Iceland on vacation. The vacation ended very quickly. But I was getting nonstop calls from clients saying, this is it. This is the beginning of some big bubble. It's about to burst. It's going to start with these small banks, going to cascade to the big ones. It's '08 all over again. If you bought the market around the Silicon Valley issues 2 years ago, you're up over 31% since then. The other big one, if you're a New Yorker like me, 2016, Brexit, Trump's first win. I can't tell you how many of my peers and clients who were more liberally leaning got very paranoid and said, this is it, I got to get out of markets, I'm going to sit in cash. These guys don't know what they're doing. If you did that, you missed a 90% return in markets since then. So this chart behind the blue box is just to remind everyone that as bad as things can feel at times, generally speaking, you're better off just hanging in there and investing through the volatility. And that's what this is showing you as well. And I don't know why my slides got all messed up. There were diamonds on the bottom of this page showing you the drawdowns every year. And in almost every year, the blue bars are the actual returns that the stock market has given you. Generally, you can see, since the last 30 years, stocks tend to go up and to the right. Markets tend to be positive returning. But in every single year, you had a drawdown of generally between 3 and 10%. So what we've experienced the last few weeks is actually normal historically, and it would be very normal to think that we could still end the year on a positive note. But again, people tend to get nervous when volatility happens. I like to use this chart just to remind them that it doesn't mean that the world is going to end. Two more things I want to hit on, then I'll open up to any questions. Big question I keep getting, okay, the world feels very scary. I talked a little bit about bonds. What else could you do to protect a portfolio? Gold. I'll cut off the potential question I may get about crypto right now. Gold is the original portfolio, or we call it the OG portfolio protector. Crypto is not. It is much too volatile to serve in that capacity right now, maybe someday. But the fact of the matter is there are very strong fundamentals for gold still, even after the 28% rally that it had last year. And the big fundamental driver of gold prices is the buying of central banks. Central banks around the world buy gold to support their economies. And what we're showing here on the right-hand side are surveys of central banks and what is their anticipated spend. Are they adding to their gold stores or are they reducing it? And the blue is people adding. And you can see in recent years, and it ticked up in 2024, a significant amount, 80% plus of central banks continuing to add to their gold stores. And again, part of that is to support economies, part of it is to diversify away from the US dollar. This is all very supportive, we think technically, of gold over the next few years, plus the fact that it tends to insulate portfolios very well from volatility. I have many clients who say to me, I'm worried about the Middle East, I'm worried about Russia, Ukraine. They tend to buy treasuries. Treasuries actually historically are not they protect you reasonably well, certainly better than equities, but they don't tend to be a better insulator than gold. And you can see here, gold is one of the best insulators of portfolios through geopolitical risk historically, and it's going to do much better than other things that benefit from shocks in geopolitics like oil. So if your fear is, I'm worried about geopolitical tensions, I'm worried about inflation, I'm just worried about the US and the deficit, gold actually makes a ton of sense and had fallen out of favor when rates started to go higher, but I think should really be a part of portfolios. The other big thing that I would mention here, and that this chart's a little bit busy, this is a really important one. because the other big insulator in portfolios are bonds, not necessarily treasuries, but bonds where you're taking a little bit of risk. What this chart is showing you is almost every single year, the only exception was 2022. The only exception, going back to it looks like the early 90s, 91. Every time equities were down, bonds gave you a positive return. So if you don't believe my outlook, that we see equities bounce back before year end, and you're trying to think, what should I do with cash, or where could I hide? We continue to believe that actually bonds make a ton of sense. The reason it didn't work in 2022 is you had a sharp increase in rates that year. That tends to be bad for bonds. I talked earlier about how we think bonds are priced better right now, and so I'm actually not as worried about an increase in rates hurting you. And so for me, when I get this question from people, as I talked about earlier, you don't want to get out of the market when you get scared because you could miss that 30, 90% return. It's just about shifting your portfolio a little bit, adding to things that will do well. That's how we think about gold, it's how we think about bonds. I'll skip hedge funds because that's a bit of a fraught topic. Last thing I want to talk about, and then I'll wrap up and leave a few minutes for questions. I've been getting this question from a lot of people saying, for the last 30, 40 years, really one of the best games in town was to be long the US. US risk assets, US equities, US bonds. And now the question is is that over as, certainly our foreign policy seems to be shifting, and you're starting to see, again, think about what's worked so far this year, literally everything but the US. I'm not ready to make that call and say that you should be shifting your portfolio significantly outside of the US. I still think the growth backdrop here, especially from our exposure to innovation in healthcare and tech, is so much more dynamic and better than so many countries around the world. So I'm not willing to say we're going to pull the ripcord here. We still have much better productivity than countries than regions like Europe, which is what's being shown here, US productivity versus Europe. But I do think, again, you have to be a little bit more targeted. The owning everything in the US, that story I think may be behind us. And that's where, again, I want to find pockets. Who's going to benefit from the investments, from the pickup in M&A that we think is going to come, from onshoring back to the US? That's where I go back to sectors like industrials, where we think significant amount of spending will happen over the next few years from this administration. I look at other economies around the world. The other big one that we tend to focus on if you want to lean outside of the US is looking at Japan. I'm going to talk about, obviously, a developed economy, one that hasn't worked over the last 20, 30 years, but one that we actually think has some pretty interesting not demographic trends from its people, but trends from the way companies are running their corporations there. Over the last few years, the Japanese government has been incentivizing corporations to start returning more capital to shareholders. And as that's happened, they've shifted from just taking all the cash and reinvesting it and actually starting to buy back stock, starting to pay dividends. And that's given that market a real big boost, and you're suddenly seeing investors globally say, I need to start looking at Japan again. I talked about valuations in the US being pretty expensive. In Japan, 50% of companies trade below their book value. So that's like the value of assets on their balance sheet, their cash, their real estate, whatever they own. By comparison, that's about 6% in the US. So if you're looking at the world and say, okay, where do I want to go because I'm a little worried that valuations are stretched here, I think Japan looks really interesting because of a tailwind from the government trying to force corporations to do the right thing, and the fact that you're actually buying assets at a pretty interesting valuation. Let's talk a little bit, I don't want to be too Pollyanna-ish here. Risks remain. Again, these words are going to be hard for you all to read, but I'll hit on the three biggest ones. Macro uncertainty. So again, our view, we're cautiously optimistic. In spite of the fact that we're down year to date and down almost 10% from highs, we think you could still end the year positive. That, though, is predicated on the fact that we think corporations can still grow earnings through the year and that you're actually able to get a couple Fed cuts. If we can't get those cuts, that's probably because we're in an inflationary environment and something else has happened, maybe due to tariffs or something else. And that's how the story starts to unravel. So in my opinion, the biggest thing you're going to want to watch over the next couple of months is look at the data. See what the Fed is telling you in their upcoming meetings. Are they still on track to cut, or do they push it out to the summer or the fall? That would be a bad sign, and that would be something that I would be watching for to say, okay, maybe our view needs to change, and we need to rethink how we're thinking about markets. The second one, which is super hard to predict, geopolitics. The risk is always out there. I mentioned I don't want the tail to wag the dog because it's almost impossible to predict when there's going to be a war, how long it's going to last. And I think if I had said to you a few years ago that we'd still be in a situation with a conflict in Europe between Russia and Ukraine, that would have been a reason to maybe not be invested in markets. You would have missed a big rally, not to mention a really big rally in Europe this year, which is up 10%. So I don't want to say that you move out of the market or change your investment strategy because of geopolitics, but we need to be aware that there's a couple big things that are still there. Tensions in the Middle East and questions around China and Taiwan, I think are the two biggest ones. Do you see some sort of de-escalation between, in Israel and the Middle East, as well as with Russia and Ukraine? We need that for things to stabilize and Europe trends to continue. And we need to still be in a state where we're not worried about China invading Taiwan. Our house view is that is not on the table for the next few years, but longer term, certainly a risk. So if something like that were to happen, I would say all bets are off. If you had an invasion of Taiwan, that would be a significant drawdown kind of situation in the market where you're looking at a 20% kind of correction. I put that as a low probability event, though, so I don't want to scare people. The last one on the right-hand side, Washington, and obviously changes in the administration. Here, I don't mean necessarily tariffs, so that's certainly part of it. But what we're going to go through over the next few weeks with the potential government shutdown, debt ceiling negotiations, things like that, those tend to be short-lived. They tend to cause volatility in a 1, 2, 3-month horizon versus something really long-term. But that could be something else that could derail our view for the market to bounce back as we get into the back half of the year and into the summer. If they just keep kicking the can out a few months and we keep having these arguments and negotiations in perpetuity through 2025, I could see a world where that puts a lid on our stock market returns that makes it kind of hard to reach the target that I wanted to hit on. I've been doing a lot of talking, and I could filibuster here all day, but I did want to open up for questions. I know I hit on some stuff that I've been getting questions about, but I'm happy to hit on anything else or try to answer any other questions that you guys have. I think there's a mic here somewhere. I can't really see much with the lights. But does anyone have a question? You can shout it out or grab a mic, or I think I see hands moving, but it's hard to tell. I see someone back there. I just can't tell if they have a mic to shout out questions.
If we have to take one thing away from this report, what would be the one metric that you would we should focus on to see whether this report is on the right track or not, the market outlook is on the right track or not? What would be that one metric?
Yeah, I think the way everything falls apart, the biggest thing for me is the macro uncertainty, the first one. Does this noise around tariffs change consumer confidence, the way people are spending, the inflation outlook? And then that's sort of three things, but I would be watching all of those metrics. Consumer confidence gets reported on a regular basis, inflation every month. Like, if you see a change, you see inflation start picking up because of the immigration changes and the tariff changes, that's bad. That's going to mean rates maybe can't keep going down, they may need to go higher. If you see consumer confidence really start to come down, again, it shouldn't be coming down because people still have jobs and their balance sheets are good. But does it come down because they start to get worried and say, you know what, I am paying more for eggs. What if this spirals out of control? That can be like a self-fulfilling prophecy. Even you don't need to lay people off or people start to get very worried. So those are like the couple metrics I'd be watching most. Again, we being JP Morgan, we see a lot of this because we see credit card data. We're still seeing people spending. They're not spending at the highs they were at a year ago, but they are still spending and they're still paying off their credit cards. So like, I'm not seeing those cracks yet, but that's the data I'd be watching, and you'll get some of that, like when banks and credit card companies report earnings, they all talk about delinquencies. Look at auto delinquencies, look at things like that. Like, those are the things that when people stop making their car payment, you know things are starting to get bad. So I would watch that. Because I don't think you're going to see it in corporate earnings. There'll be a bit more of a lag there because corporate margins have widened so much that like they probably have more levers to pull. I think what you'd worry about is the sentiment changing and people just pulling back because they're just tired of the noise or scared that they might lose a job.
One of the indexes that I looked at was trade policy uncertainty index, and it is at the all-time high.
Yeah.
How do you see that impacting the...
I think that's a very good indicator of just general fear in the market. Now, that's trade policy uncertainty. I will tell you, most US consumers do not follow this stuff the way that we all do. So I want to be a little cautious about using that as like a barometer for the broad US consumer and how they're spending, because again, as long as the average person in the street is still going out there and taking a vacation and buying a car, that's okay. But that could be something that, again, continues to spill over. If this stays in the headlines more and more, this is why the tariff thing, I think, is so dangerous. I have no problem with putting on tariffs and just putting them there. But it's the on, off, this, that, and like it's continuing the headlines over a long period where I think you start to scare people, normal people, who don't follow this. So that's where I get more worried, when it spills over into like the regular US.
Thank you.
I thought I saw their hands, but I can't really see. Yeah, I don't know if you can get to the mic, but.
I appreciate your outlook. It's a 2 to 3 year outlook, mostly what I'm hearing. I'd love to hear your thoughts if you expanded that to 10 or 20 in the context of what I think are some of the geopolitical trends. So a peaking China with its own demographic and financial problems, disentanglement with them, maybe a Europe that's retrenching around Europe and less entangled with the United States and the maybe reindustrialization of the U.S. that people are predicting. What are your thoughts about extending your predictions 10 or 20 years in the macro?
Yeah, I mean, people in my seat never want to do that because it's so risky, right?
That's why I asked.
But more importantly, I'm probably not going to be standing here in 20 years, so let's go wild. What do I think? All right. The big thing, and we've written about this, JP Morgan, our strategists, no empire lasts forever. And I'm not saying we're Rome necessarily, but we have been kind of. When I think, and I work with a lot of clients who plan for perpetual money, some of my wealthier clients, if you have $1 billion, you're not thinking about the next year or two. You're thinking about your kids, your grandkids, et cetera. The way we've been managing those portfolios is much more global diversification, to your point. Because to assume that the US remains the superpower it is in perpetuity, I think is a false assumption. And when you look at things like our US debt, if that doesn't get fixed, there's zero chance the dollar will remain the reserve currency in 20 years, in my opinion. And that's a big challenge. Now, what's not clear is who takes over. I think the obvious answer is China, and that's certainly their goal. And so what we've been doing with families who are planning for kind of that perpetual wealth is they have much more diversification outside the US. Again, they're not giving up on the US because a lot of this stuff, and actually the onshoring and stuff like that, could actually bring a lot of industrial manufacturing back to the US in 5 or 10 years. But you can't build this stuff in 1 year. You don't build a chip factory in like a month. And so I think there's like pockets of the US that make sense for that longer term time horizon. But I think if you're investing long term and you don't have more exposure in emerging markets and more in China, you're making a big mistake. How have my clients been doing that? A number of my families who are mostly US dollar denominated have started to diversify their portfolios into other currencies. They've also just bought options to play for like a 5, and you can't really buy a 10-year option. It's not very liquid. You can buy a 5-year option, though, on the China equity market. And they've been putting things like that in their portfolio to bet that those economies are potentially the winners when things finally shift longer term. Now, I mean, there's obviously questions about China's demographics and the underlying economy, but I think the difference, and I think what most of us would agree, is they are able to take a long-term view, whereas in the US, we get a little bit more mired in like a 2-3 year outlook, to your point, and that makes it very difficult to have a long-term plan to like sustain an economy. So those are a couple of things that I would look at. Europe is a little bit more challenging. I think there's like pockets of Europe you might want to look at, but I haven't had people make substantial investments that they're thinking that Europe's the winner long term. I think at one point the answer might have been what replaces the dollar, maybe the euro. I don't think anyone believes that right now. I think I maybe have 1 minute left if anyone has anything else. Otherwise, I see somebody moving.
Hi.
Oh, hey.
Great presentation, by the way, so good job. 2 questions for you.
Yeah.
One, geopolitical. What if China decides to invade Taiwan and the impact on global markets? That's the first question. The second one, how much are we worried about the US national debt and all the attempts to control it, reduce it, short term, long term? So 2 big questions.
Yeah.
Thank you.
Yeah, let's end on a low note. 2 depressing things. China, Taiwan. We know they want to do it. I don't think they have the ability right now to do it, or the military right now to do it. But certainly that's where this is going. That's why we're trying to bring chips back here. Let's say they do it tomorrow, cataclysmic for equity markets. Because not only is it there's a major escalation and cutting off of chips that everyone needs globally to live their lives, but there's a big question about, is the US going to defend Taiwan right now under this administration? And that, I think, would just cause like so much uncertainty in the market. I think you'd be looking at a 20% kind of correction. And I have clients who actually were trying to hedge for that outcome. It's a very expensive hedge to put on and maintain in a portfolio. but I've had more questions about that risk than others over the last year or two. I will tell you, JP Morgan employs a council of thought leaders, people from former administrations, big names, Condoleezza Rice, et cetera, and they meet constantly to talk about this. Their best guess is we're still a few years away from that likelihood seeming more likely, but that's still pretty scary that they're talking about a few years away. So in my opinion, that's like a worst case scenario. This is why it's so critical that we try to broaden out our dependency on certain critical chips and infrastructure outside of that country. The debt and deficit, it's not a problem right now. It's not a problem in 2 years. It's a problem in 10 years. And it goes back to that view of why the US won't remain the US if we don't get it in check. Right now, we're able to kick the can. People are still buying our debt. It's fine. That just won't last forever because at some point, and every time we threaten to shut down the government or threaten to not pay our bills, it chips away at that credibility that the US is, again, the reserve currency of the world. So I think those are probably two of the biggest risks that we're facing economically from a US standpoint over the next 10 or 15 years. I just don't think the deficit risk is that scary right now because there's no other alternative. There's no alternative to the dollar right now. You're not going to go invest all your money in China where you can't sue someone if you own a bond to get your money back. Like, it's not going to happen. But could it happen in 10 years? Maybe. And that's why I think it's so critical, and that's why I agree with the administration that you want to get this under control now, because it takes a long time to fix this stuff. It doesn't get fixed in a year or two. I question whether it gets fixed by lots of tariffs and also cutting taxes. I think you have to have a real plan to get this fixed over 5, 10, 15 years, and that's probably our best bet to maintain some sort of global superiority in the longer term. I hate ending on a sad note, but it is what it is. I'm out of time, but if you guys want the slides, you can follow up, and thanks for all the questions. It's great to see you. I'm hopeful that if I come back next year, everything will be rosy, and we can just talk for 20 minutes about fun stuff, but thank you all.